Hello, welcome to my pencast, Counting 1110, where my goal is to determine how inventory costs are calculated in a perpetual inventory system. I'm going to demonstrate for you in the course of the next few pencasts calculating inventory costs under 4 methods. Specific ID, I abbreviated a little, FIFO, first in, first out, LIFO, last in, first out, and then it's called weighted average. I will do a separate pencast on each one of these to try to keep the information and the pencast short. If you are using the Horngren book, the 10th edition accounting book, you can follow along. I am going to use a different approach to solving the information on pages 367 to 375. They use an approach of showing you how to calculate inventory records, and I don't want to use that approach. I want to deal with the numbers and the theory and show you what's happening. If you're not using that book, that's okay. I'm going to put this on pause and write down the information we're going to be using so you can follow along and just not see the inventory records in that book. Hold on a sec. So welcome back, and here's my facts. I have some iPads. I have one iPad, and I have on August 1st, beginning inventory of 2 iPads at $350 each for a total of $700. Following down the next line, on August 5th, I purchased 4 more for $360 each for a total of $1440. I sell 4 on August 15th. On August 26th, I purchased 12 more at $380 each for a total of $4,560. On August 31st, I sell a total of 10 units. So I have $700 in beginning inventory, and if you add up my 2 purchases, you'll see they total $6,000. I'm going to use the same set of facts throughout all my calculations. I want to introduce you now to a basic formula that you will use in calculating cost of goods sold in many upcoming accounting classes. So although it's not as important in this class, I'm going to start fresh and always use it with you so it will be something you're familiar with. Basic cost of goods calculation says, what do you have in beginning inventory? And from our records above, you can see I have $700. To that, you add net purchases. In my example above, you can see I have $6,000 worth of purchases. If I start the period with $700 and I purchase $6,000, the total I have available for sale is going to be $6,700 worth of inventory. Some of that is going to remain in my ending inventory, and some of that is going to go into cost of goods sold. Ending inventory is what's left, and it goes on the balance sheet. And cost of goods sold is how much you sold, and it becomes cost of goods sold on the income statement. Using the format that I'm showing you, you literally split the total available between ending inventory and cost of goods sold. You'll see me use this as we progress throughout this example. You can also see that we have 2 sales. There's one on August 15th, and it tells us in the book that we sold 4 units at $500 each on account. So it would be accounts receivable and sales, as you learned in our last chapter, dated August 15th. At $500 a unit, selling 4, that would come up to $2,000 for accounts receivable and sales. In our last chapter, we just gave you the amount of cost of goods sold and inventory. And in this chapter, we're going to have you calculate it. Notice we also have a sale on August 31st. We have the same problem. In accounts receivable, we sold 10 units, and again at 500 each, so 10 times 500 is 5,000. And we have a sale of 5,000. There's part of our entry, but then you need to come back and do the cost of goods sold and the inventory reduction. And once again, which inventory did we sell? We had 2 at $350 in beginning inventory on August 5th, 4 at $360, and on August 26th, 12 at $380. Which 4 did we sell on August 15th? And on August 31st, which 10 did we sell? We're going to explore how you calculate that using 4 different kinds of inventory methods. Look above on top of this and you'll see it's the specific ID, FIFO, LIFO, and weighted average. In all cases, I'm going to show you the T-account method for solving what cost of goods sold would be for specific ID, FIFO, LIFO, and weighted average. So, I'm excited to get started. I'm also going to come back and show you how that fits into our basic cost of goods sold calculation. We know we started with 700. We know we purchased 6,000 from our above information. That means we had 6,700. We sold 14 units, and we have 10 left in ending inventory. It's just which 10 or which 4 are left and which 14 are sold. Let's move on and figure that out. Thanks for joining me for this first pencast on introducing the topic.